Guys and girls, welcome back to another Bumond Outlook's fundamental educational video. And today we have inflationary and recessionary gaps. Now, what are they? Inflationary gaps and recessionary gaps are two key concepts in macroeconomics that describe different economic scenarios, each with distinct implication for fiscal, which is government policy, and monetary policy, which is central bank policy, and by extension, foreign exchange valuations. Understanding these gaps help in analyzing economic conditions and anticipating potential impacts on currency markets. Now, inflationary gaps. An inflationary gap occurs when an economy's actual output exceeds its potential output at full employment, leading to upward pressure on prices or inflation. This situation arises as an overheated economy, where demand outstrips supply. So just to recap on that, this actually happens when the economy's actual output exceeds its potential output at full employment. So in other words, there's a lot of spending, a lot of consumption, a lot of growth, more than, of course, its potential at full employment. So it's a big spike and it's a big inflationary gap. Now, what happens here in the short term is initially the currency might start to strengthen due to positive growth perceptions and inflows of foreign investment seeking high returns. But long term, if it's persistent, the inflationary gap, it can erode purchasing power and lead to higher interest rates as central banks attempt to cool the economy. Higher interest rates can attract foreign investments, strengthen the currency, but if inflation is not controlled, it can lead to loss of confidence, causing it to weaken. Now, recessionary gaps. A recessionary gap occurs when an economy's actual output is below its potential output at full employment, indicating underutilized resources and high unemployment. This scenario reflects economic downturns or recessions. Now, of course, in the short term, a recessionary gap can lead to weaker currency due to reduced investment inflows and lower interest rates, as central banks are really trying to stimulate their economy and encourage you to borrow. But long term, if this is a prolonged recessionary gap, it can significantly weaken a currency due to the lack of confidence in the economy's health. However, aggressive monetary policy easing and fiscal stimulus can eventually restore confidence and then, of course, reboot the economy into a recovery. So we can see here how inflationary gaps tend to temporarily strengthen a currency, whilst recessionary gaps tend to temporarily weaken a currency. Now, interest rate adjustments can occur as central banks may adjust interest rates to manage inflationary or recessionary gaps, influencing the currency's valuation. Higher rates attract foreign capital. Of course, higher rates would occur on an inflationary gap, strengthening the currency, while lower rates, which of course would occur on a recessionary gap, have the opposite effect. Now, investor sentiment will change with this. The perception of an economy's health is based on whether it the perception of an economy's health based on whether it faces an inflationary or recessionary gap can influence investors and, of course, global expectations of that currency strength. A robust, inflating and inflationary gap growing economy can attract investment, whilst a struggling recessionary gap-based economy can deter it. Policy responses are there for this. We will get fiscal and monetary policies adopted to the environment to address these gaps and can significantly affect currency valuations. For example, fiscal stimulus in a recessionary gap might boost economic activity and support the currency, whilst tightening monetary policy in an inflationary gap might strengthen the currency by controlling inflation. Trade balances is something that's worth noting here. An inflationary gap might lead to increased imports due to high domestic demand, worsening trade balances and affecting the currency negatively. Now, on the other hand, during recessions, imports might decrease, and if exports remain stable, then trade balances could improve. So this is just one very obscure way of looking at how to digest these gaps. Now, I hope you've understood simply a very short video on what inflationary and recessionary gaps are. And as you can see here, inflation and recessionary gaps indicate different economic conditions and have varied impacts on FX. Central bank policies, economic recovery or overheating signals, and changes in investor sentiment can, of course, be in response to these gaps, and they play a crucial role in currency strength in the global market. We don't always have recessionary gaps. We don't always have inflationary gaps. But if we do have one in the future, you now know what they are, and you now know how the policy may change, how the government may react, and how the FX valuation may change as a byproduct of this. Thank you for tuning in, and let's jump into the next episode.